Welcome everybody to the Hot Topics series. This is a first in a series sponsored by the Center Club. I'm Linda Katz-Wilner, and I'm the founder and director of Successfully Speaking. I'm a communication and soft skills specialist. And what I was hoping to do was bring some information and content experts to the audience of the Center Club while we can't be physically getting downtown. And so I'm thrilled today to have two experts, Alvin Katz, who is no relation to me, even though I'm Linda Katz-Wilner. Alvin Katz, who is the co-founder and director of Katz Abosch. And we also have Michael Andrews, who's a tax manager. And we know that a very hot topic is the impact of the CARES Act on taxes. And so we thought this would be a wonderful way to kick off this series. So first of all, I welcome Alvin and Michael, and thanks so much for taking the time to be with us here today. What we're going to do, I want to talk a little bit on how this was organized. I had the opportunity to interview Alvin and Michael Wednesday. We wanted to wait and make sure that we're current on all of the information about the CARES Act. So what we're going to do first is we're going to show the interview, which is close to 20 minutes. We have the interview with questions that we know most of you probably have right now. And so we will focus on the content of those questions. Following that, we'll have a Q&A. But what we'd like you to do is while we are playing the video, write down in the chat box. Try to locate the chat box right now. Write down any questions, and as soon as the interview is over, then we will start to answer those questions. We'll have a series of questions, and I first want to ask you a question, Michael. How does the CARES Act have an impact on the individual's income tax?
Yeah, so there are two large areas where individual taxpayers are going to be impacted. The first of which is not actually in the CARES Act, but it's important to note, and that has to deal with the filing deadlines. So the original filing deadline of April 15th has been extended to July 15th to file your federal income tax. There's no extension needed to be filed with that. It's automatically extended. Maryland has followed the federal extension and is now due on July 15th. However, if you have other state filings, you want to look into what the rules are in that particular state, because not all states have followed the federal guidelines. Additionally, the 2020 first and second quarter tax payments have been extended to July 15th as well. The extended deadline will give you some more time to also make a contribution to your IRA account or to a health savings account, an HSA account. So that's item number one. One item in the CARES Act that will impact a number of individual taxpayers are the direct stimulus payments. So these are essentially payments being made to taxpayers, $1,200 if you file a single tax return, or $2,400 if you're married filing jointly. Many taxpayers will see a check, or maybe have already seen a check come to them. However, it is phased out at certain income levels. So if you're a single filer, the direct payment begins to phase out at $75,000 of income and $150,000 of income if you file a married filing jointly tax return. That will phase out and continue to phase out until $99,000 for singles and $198,000 for married filing jointly. Additional payments for any dependents that you claim on your tax return, you'll get an additional $500. And they'll be using the information from either your 2018 tax return or 2019 tax return to calculate the amount that you'll be paid. One last area pertaining to the stimulus are there's some confusion of, will this have to be repaid, or what if information changes in 2020? So this is actually an advance payment of a 2020 credit. So next year, when you're filing your 2020 tax return, there'll be a calculation for this credit going through the guidelines that I've just mentioned, and then that credit will be reduced by the amount that you've already received. So if something happens in 2020, say you had another dependent or had a child where you would have gotten an additional $500, but that wasn't reflected on your 18 or 19 return, that'll be trued up on your 2020 return. Conversely, if you made too much in 2020 and should have phased out, but that wasn't reflected, you will not have to pay that back.
Interesting. So there are a lot of extra details that I was not aware of. And here's another question that we haven't discussed yet, but where do we see this money? Does this show up in our accounts? Do we receive a check in the mail? Does it vary?
It varies. You know, that's a very good question. If you file electronically in the past and have direct debit set up and have had your refunds refunded directly into your bank account, that information will be used for your prior tax returns. However, if you don't use that and you either pay by check or receive a refund by check, the government will be mailing out the physical checks to you directly. So it depends on what you've done in the past.
Mm-hmm. Well, that's really helpful. Thanks for that. And Alvin, I have a question for you. What is the impact on our charitable donations?
Good question, Linda. And hi, everybody. Glad to see everybody. Hope a lot of people are watching this. And Mike and I are enjoying being able to respond to Linda's questions and hopefully impart a little information with people. One of the areas for cash donations is that those people, now let me explain something. Many people started taking a standard deduction as opposed to itemizing their deductions, starting with their 2018 income tax returns, because the standard deduction was increased significantly, so that people no longer have to itemize. And for those who are taking a standard deduction, they can now take a $300 charitable deduction on the front page of their tax return. So as part of calculating their adjusted gross income. So instead of just getting a standard deduction, you now get a standard deduction plus the $300 charitable deduction that can be taken on page 1 of your income tax return. In addition, contributions have been limited to 60% on an individual return of your adjusted gross income. That has changed, and it's now up to 100%. So plainly speaking, if your adjusted gross income is $100,000, in the past, the maximum charitable deduction you could take was $60,000. Now it's $100,000, 100% of your adjusted gross income. And last but not least, on corporations, C corporations. Corporations were limited to being able to deduct 10% of their net income as charitable contributions. That percentage is now increased beginning with 2020 tax returns to 25%. So that's another big opportunity for corporations to make donations and get a charitable or get a tax benefit out of it.
Okay, that's good news, right? We get more benefits now.
Yes.
Now,
Yes.
Another question that many of us may have is, what about our retirement accounts? And Michael, maybe you could address that.
Absolutely. So there are 3 areas we've been speaking to a lot of clients about and how retirement accounts have been impacted or could be utilized under the CARES Act. The first of which, the 10% penalty from an early withdrawal of a retirement account has been waived. And this is for eligible individuals. So an eligible individual would be someone who was impacted by the coronavirus, whether they actually had the virus, a spouse had the virus, their work was limited, or they lost their job due to the some of the restrictions that governments had placed. So if you're in that category, and while we don't generally recommend disrupting the accumulation of retirement assets, if you need to, or if this is something that would be beneficial to you during this time, you can withdraw up to $100,000 out of a retirement account without having to pay the 10% penalty. In addition to that, you have 3 years to pick that up as income on your individual tax return. So there could also be, if you're in this situation, some planning as far as when you pick it up in income. You don't have to pick it up equally over 3 years. You can choose a year to pick it up, and maybe that's a year where income was down. You're in a lower tax bracket that you would want to include that in your taxable income. Secondly, required minimum distributions have been waived for 2020. So if you're a retiree who is subject to starting to take your RMDs, taking money out of your retirement accounts, that has been waived for 2020, so you don't need to do that. And this is beneficial in two ways. A, you don't have to pick up that additional income, so you're saving some on taxes, as well as because of the correction in the market that we've seen, you're not withdrawing on lower asset values. So you can leave that in your account to let it grow and retain its value without disrupting that. And lastly, not in the CARES Act, but a strategy that you may want to talk to your tax advisor, your financial advisor about is looking into a Roth conversion. The Roth conversion strategy is something that we work with clients, all the time with, where you take traditional IRA assets and convert them into a Roth asset. So you pay the tax on that amount that you've withdrawn in the current year and put it in a Roth IRA account where it will continue to grow tax-free as opposed to tax-deferred. And then during this time, as I mentioned, asset values are low because of the correction in the market, and we're in a historically low tax environment. So it might be a good strategy during this time to make some Roth conversions. But like I said, you definitely want to work with a professional and someone who can help you map that out if that's a strategy that's beneficial at this time.
And that's helpful, right? It's a lot of information that none of us can just figure out on our own. So certainly we should use our tax advisors.
Absolutely.
For that. And Alvin, for those of us who have businesses, everybody's talking about payroll taxes. How has that been impacted by this act?
Well, in a couple of ways. First of all, employers who have employees, obviously, may defer the payment of their share of Social Security taxes on wages paid from March 27th to December 31st, 2020, as is mentioned in the slide. In other words, if you're paying payroll, you're withholding Social Security as well as other withholding taxes from your employees, but the and that has to be paid, the portion that's withheld. What you don't have to pay until in the future you're being able to defer it is the 6.2% of the employer's share of Social Security taxes, which would be from March 27th, payroll March 27th to December 31st, 2020. Also, self-employed individuals may defer 50% of their self-employment taxes in the same fashion and on the same dates. That money ultimately will have to be repaid to the federal government. Half of the payment will be due on or before December 31st, 2021, and the other half by December 31, 2022. So again, to put some numbers to it, say you have $500,000 of payroll and nobody reaches the maximum, and you have 6.2% of Social Security taxes that are your portion to have to pay. I believe that would come out to about $30,000 and change. That means that $30,000, the employer's share, that $30,000 can be used for other things, working capital, et cetera, and does not have to be paid to the federal government until $15,000 would be due before December 31st, 2021, and the other $15,000 would be due on or before December 31st, 2022. There's no penalty, there's no interest. It's like an interest-free loan from the government. The last thing is, and this is not a deferral, all other taxes have to be paid timely to the federal government. The employee's share has to be paid on time. Now, there's one other thing that's not on the slide, and that's with the state of Maryland. The state of Maryland is allowing taxpayers to defer the payment of Maryland withholding taxes that are withheld from employees from until June 1st of this year. It's not a long deferral, but if you have a cash flow crunch or something like that, you have until June 1st to pay Maryland withholding taxes that have been withheld from your employees over the past, let's say, basically April, May, and due June 1st rather than right away during those months. So these are deferrals. These are sort of tax-free loans from the federal and the state governments. If you need the dough, it makes sense to take advantage of it.
Mhm. So your point is that they are deferrals. They do have to be paid ultimately next
Yes,
year.
yes, yeah, Linda. These are not forgiveness of tax. These are deferral of tax.
Mhm. Okay, that's helpful to know that. Michael, what's the impact of the qualified improvement property? And I don't know a lot about that at all, so maybe you can explain that to
Right.
us.
So this is actually one that tax professionals have been waiting for. So this is a correction to an error that was actually in the Tax Cuts and Jobs Act from 2017. So it's a few years old. So I'll start with, what is qualified improvement property? Qualified improvement property refers to improvements made to the interior portion of a commercial building, so non-residential buildings. The improvement also has to have been made after the building was placed in service. So improvements made to a commercial building later on after the building's already been placed in service. So as I mentioned, it was a technical correction. So when the Tax Cuts and Jobs Act was passed, it was Congress's intent that all of this qualified improvement property would be depreciated over 15 years. So it's 15-year property. In addition, if it's 15-year property under the tax law, it is eligible for 100% bonus depreciation. So you could take the cost of the improvement and expense 100% of it in year one. What happened when drafting the legislation, there was an error that made qualified improvement property 39-year property. So not only did the depreciable life go from 15 to 39 years, where you would have to deduct the cost over a longer period, under tax law, 39-year property is not eligible for 100% bonus. So we had a lot of clients and people who had made improvements that now have to depreciate and take that cost over 39 years. So the CARES Act included a technical correction to that. This was a correction, as I mentioned, that many people were anticipated. It just finally got done in the CARES Act. So now it is 15-year property. You can take 100% bonus on any of those improvements. If you had an improvement in 2018 or 19, you can go back and amend your return to take advantage of that. And in addition to being a correction, it really helps some folks during this time, not only in the real estate industry who might own some non-commercial rental real estate, but if you are any business that rents a space and have made improvements and have that on your balance sheet, you can take that as a 100% bonus. And one area that typically carries a lot of improvements are restaurants, which is definitely an area that needs some relief during this time. So if you have that, again, speak with your tax advisor about possibly going back and amending returns to lower past year's tax liability and getting some cash flow from that.
Very helpful. Thanks so much for that, Michael. Now comes a big question that people have been talking a lot about, and that's the Paycheck Protection Program, the PPP. Alvin, are there any updates on that?
Yeah, there are. As I imagine everybody watching knows that the first tranche of money was gone through very quickly. And now we're in the second tranche, which came out, I believe, this past Monday, if I have my dates correct. And by the time you all see this interview, we're anticipating that the PPP money will be depleted. PPP has become a new part of our parlance. Until a few weeks ago, we didn't know anything about PPP. So this is the opportunity for businesses to borrow money, apply for and borrow money from their bank, guaranteed by the SBA program. And the monies that are borrowed on the PPP program are to be used, or were to be used and continue to be, for primarily payroll, with some being used for rent or mortgage payments, as well as utilities and interest. And that's basically what that money is for. if after the first 8 weeks of your having that money, you have spent the funds in accordance with the guidance and guidelines that have been set forth, those amounts will be forgiven. Anything that has not been used may be converted, either paid back or converted into a loan in which the interest rate is less than 1%, slightly less than 1%. The repayment of those monies is to be delayed for 6 months and then repaid over a period of 18 months from the time from which would be around, I may not have the dates exactly right, but at this point, from around January 1st of next year, December 31st, December 1st, the end of this year, paid back to the bank over an 18-month period. By the time this is aired, again, I think I said this already, we're anticipating the funds will be depleted. The last bullet point here is, may we expect additional funding from the Treasury? My guess, our guess is, and you can't take this to the bank, but our guess is there will be more funding coming available. There's also another program that is not on this slide. It's called the EIDL, the Economic Injury Disaster Loan. The government has had this originally. The money went, you could have snapped your fingers and the money was gone. There's two things available here. Loans, I believe, up to $2 million per company. And I think that was a $50 billion fund in the second go around. And then a fund of $10 billion, which will provide grants up to $10,000. The restrictions, if I understand correctly, are not as tight on this money as with the PPP. These are for companies that are really having trouble meeting expenses, et cetera, and they have the opportunity to apply for these loans.
I can't say it's all wonderful news that we're hearing, but it's the current news, and it's been so helpful to have both of you update us on all of the things that we need to know about with the CARES Act. Thank you again, Alvin and Michael, for all of this information. And what I'd like to do now is take a look at the chats. I couldn't see the chat while this was going on. Let me ask some of the questions that I see here. Let's see here. Michael Lester asked, I'm wondering if you saw this article, have thoughts or issues about fairness, resentment that the act might provoke in terms of income inequality. He was talking about a New York Times article, the tax break bonanza inside the economic rescue package. He said, as small businesses and individuals struggle to obtain federal aid, the wealthiest are poised to reap tens of billions of dollars in tax savings. Alvin or Michael, do you have a response to that? Alvin, you're muted. Alvin?
Well, when
there we go.
Okay. So Alvin or Michael, who wants to answer that or comment on that?
I think, Alvin, did you have something to say on that? You began.
Yeah, can you hear me?
Yes.
Yeah. I wanted you to read the last part of that again. You lost something in the translation, and if you heard it, Michael, go ahead and answer.
I'll just repeat, as small businesses and individuals struggle to obtain federal aid, the wealthiest are poised to reap tens of billions of dollars in tax savings.
I don't completely understand the question, and I'm not sure what tax savings the person is talking about. As you've seen, some companies have gotten the money. One of the ones that really stands out are the Los Angeles Lakers. They received, I forget how much the loan was from the government, and they returned it because they realized that they couldn't use it or didn't need it in the fashion described. And another was a chain of restaurants in New York City. I can't think of the name of it.
With Chris? Was it with?
I can't think of which one it was. They got like $10 million and returned it. So I'm not sure what savings we're talking about, because as I understand it, if you use the monies for the purposes that they're described and you get forgiven the loan, you then cannot also deduct those expenses like payroll expenses. You can't double dip. So they become non-deductible expenses. So I'm not quite sure if that answers the caller's the question or not. Mike, you want to add to that?
I mean, just to follow up on a number of things that you had mentioned, we've seen, certain companies that got the loan that probably received it, taking away from probably some smaller business that needed it, and those have been scrutinized. I hadn't read the particular article that was mentioned.
Mhm. Okay, and the link will be there if you want to check that out afterwards. Another question from Marianne was the inherited IRA RMDs are not waived this year. Is that correct?
My understanding was that those are included in being waived. I'm happy to look further into it, but my understanding was that those were included in being waived for 2020.
Okay. All right. Now, if anybody wants to have me open up the line, if they want to ask a specific question, if you can open up your managed participants, there's an option to put a yes mark. So if I see a yes mark, I'll unmute you. But in the meantime, we have some questions that were emailed to us, Michael and Alvin. Karen Kursky, I'm not sure if she's on the call. She said the timing for rehiring employees when you get a PPP loan. Do I need to get them back on payroll before the funds are deposited? Is it the same day as deposited, a day after receipt? And she can't find the detailed rules to ensure the funds qualify for forgiveness. Can you respond to that?
So there's a lot to that question. As far as the loan forgiveness, all right, generally speaking, using the funds on payroll ensures, the most likelihood that it'll be forgiven. One rule is that, 75% of the proceeds have to be spent on payroll, other 25 on things like rent, mortgage, utilities, things of that nature. As far as the hiring or rehiring of full-time equivalents, so there's also another kind of aspect of the loan forgiveness that we're still waiting on details, but as it understood, your full-time equivalents for the 8-week period, beginning on when you receive the funds, will be compared to a measurement date. And that measurement date, my understanding, is going to be to the borrower's discretion. You could use 1/1 through 2/29 or 2/15 through 6/30. So the full-time equivalents will be compared to that measurement period. And if you have a drop, right, the loan forgiveness amount then decreases by the drop in full-time equivalents. To add more, to muddy the waters a little bit further, there's also an area where it says that if you restore full-time equivalents and payroll by June 30th, the full-time equivalent test is ignored. And that's about as clear as mud, and we're certainly waiting for additional guidance and clarity on that. But as it stands, that's how that works. So, to answer our question specifically, you want to pay as much payroll during the 8-week period, but you get full-time equivalents restored by June 20th. That test may be ignored.
Just so you should know, to add to that, and Michael makes it very clear about it's clear as mud. The American Institute of CPAs and other organizations are lobbying to get more clarification and perhaps some more leeway in this. So we really don't have a firm answer at this second in time. We just have to keep our eyes open to see what comes through.
And another question that just came in was, are there any updates to the SEP accounts?
To the
self-employed pension accounts.
Any updates?
That's what the question was. That's Jennifer Langford had that question. Jennifer, do you want to clarify that? You could unmute yourself.
Was not any more adjustments in regards to what we can contribute going forward?
I believe it's the same as it has been. I don't think
okay.
I don't believe that's changed.
I think it's $56,000 for 2019, and you have until the due date of your tax return to make that, including extension. So you still have until April 15th to fund your SEP.
You mean October 15th?
Sorry. Yes.
Phew. Okay, and Armand has a question. When will the detailed repayment and forgiveness regulations be available?
We're hoping sooner rather than later, but we don't have a crystal ball. We don't know.
So you don't have all the answers, Alvin, do you?
I don't believe anybody has all the answers. I know I've
And,
spoken with people far more knowledgeable than I am, and they don't have all the answers. So no, we don't have all the answers.
Right, right. Well, you have a lot of answers, though. I must say that. Eric wants to know, isn't there a section in the code for disaster relief for employers to help employees with non-taxable payments? Now that's Eric Benzer. Eric, do you want to unmute and clarify that?
I am not a tax lawyer and I do not give tax advice, but I believe that there's a section in the code that provides disaster relief from employers to employees if there is a plan in place for personal expenses such as funerals and other things that might have unfortunately occurred during this disaster. And I think the pandemic qualifies under that. I know that there's a tax law or code section somewhere, but I don't know what it is. And I don't do tax law ever.
I can't give you a great answer, but I do remember I don't remember the specifics, but I do believe there are allowances within the CARES Act. I can't quote them line for line, but I think you make what you're asking very possibly is available.
Thank you.
Okay, and another question from Armand, is health insurance forgivable?
Employer paid health insurance, I believe, is part of payroll, the payroll cost.
Okay.
Yep.
Now, I don't see other questions there, but somebody, I don't know if Jeffrey Hill is in. He gave it's a detailed question. It may be more specific to him, but, oh, Jeffrey is there. If you can unmute, I know you had some questions about your Roth IRA. If you wanted to speak to that, we can unmute you.
So my question is, and you kind of talked about this a little bit earlier, and hopefully you're hearing me. You had talked about the 100,000 for converting to a Roth IRA. So I'm under 59, so not paying the 10% penalty is great. It seems like this is a great opportunity to convert to Roth. I have two options. I could take money from my 403B, pre-tax money, or if it's permissible, I could take money from an inherited IRA and convert it over to the Roth. And I'm wondering your thoughts on that. And if I took the whole 100,000, obviously the best thing to do is put the 100,000 in the Roth, but could I use some of that money to pay the taxes on 100,000?
So those are kind of two separate areas. The 100,000 discussed in the CARES Act that is not subject to the 10% penalty. Those funds are directed to be used to help during an economic downturn or a hard time. And since you are 59, under 59, and if you were to need to use those loans, you could take, or that money, you could take it out penalty free. Now, the Roth conversion is a separate item. You can do Roth conversions taking traditional IRA assets and convert them into a Roth, regardless of the CARES Act. And even being under 59, if you do a Roth conversion, the 10% penalty wouldn't apply to you anyway. So if you're looking more from a financial planning aspect and looking at a time to convert some IRA assets into Roth, right, the $100,000 aspect within the CARES Act wouldn't be applicable to you. Now, your question about what types of assets, generally that is done with traditional IRA assets are converted into Roth. Inherited IRAs, if it's inherited from a spouse, you can do a Roth conversion. However, non-spousal inherited IRA assets are not eligible for Roth conversions. And then I think you said a 403B. 403Bs and 401Ks, it really depends on the plan. if the plan permits you to take out funds and roll them into a traditional IRA, then you could do a Roth conversion from there. However, not all plans allow you to do that. Alvin and I actually were just on a phone call last week with a client who wanted to do a Roth conversion out his 401k. Unfortunately, his plan doesn't allow him to take out any of those assets until he retires. So he wouldn't be able to do that at this time.
I'm trying to be mindful of the hour, and we have one more question, I think, which we can use as our last question, and then we can close up this portion and move into the networking. But Richard Kraft had a question. How do you believe these subsidies are going to impact future income and estate tax laws for the government to recoup these outflows? Tough question.
That is a good question. And you might not like the answer, but it remains to be seen. We're in times that none of us have experienced before. Hopefully we'll never have to experience again. And the government's going to have to figure out how to recoup these monies, fix things that may take many years. But I don't think there's an easy answer to your question. And I certainly am not wise enough to know what the government's going to come up with. My guess is at this point, the government's not wise enough to know what they're going to come up with, because they're playing it day by day as they go along, just as we are. So, Michael, I don't know if you feel any differently, but I think it's an unknown at this point.
Right. I think the long-term impact is yet to be seen. Prior to this, we've already been in historically low tax rates. So, seeing tax rates go up is probably, the first likely scenario, I would imagine. And a lot of the tax cuts that we experienced a couple of years ago, they're due to sunset in 2025 anyway. All of the Tax Cuts and Jobs Act, that's sunsetting in 2025. And given, like the question mentioned, a lot of this money going out in government stimulus and loans. And then as we go into the next election cycle, if we see the pendulum swing the other way, we could see tax rates increase before they're set to expire in 2025.
Well, I think this is a good way to end the interview and the question and answers. And Alvin and Michael, I want to thank you so much for giving us your time, both for the earlier interview and for today, to your time and your expertise in answering your questions. And I want to thank the Center Club for providing us with this platform to share all of this information. What we are going to do is move into these breakout sessions. For those of you who aren't familiar with it, we're going to break you out into, it's approximately 5 breakout rooms where you'll be there for 10 minutes, where you can talk in a smaller group, and it's more like networking and conversation amongst each other. And one question we can address is, do you have a new strategy for your business as a result of COVID-19? And maybe we can talk about that. But I'm going to send you out into breakout groups. This part will not be recorded. But again, Alvin, thank you so much for agreeing to do this. And Michael, you as well. So I want to thank you for your excellent expertise.